The potentially most pivotal moment for markets this year is upon us. Will the Trump trade ensue? Are market makers and whales accumulating and preparing to send it? Or is the Trump trade and Bitcoin cycle top priced in? Let's discuss. If you are new to the channel, our daily updates are short format summaries of our market perspectives and trading strategies. We are a team of investment professionals leveraging our careers in traditional finance as traders, market makers, and portfolio managers for top-tier institutions, having transitioned to proprietary traders of digital assets. We have developed a methodology combining qualitative and quantitative factors, merging a multitude of theoretical constructs. Our approach translates how the pricing mechanism is influenced by market maker predatory tactics and trading algorithms, with a focus on market structure, liquidity, volatility, and time-price-volume relationships. Please note, our content is not investment advice, or is this an educational channel? It is intended for entertainment purposes only. If you suffer from analysis paralysis and prefer short-format market perspectives and rationale for our trade setups, stay tuned and enjoy. Weekend price action was volatile, not atypical of one prior to a week ripe with event risk. Market makers were in predatory mode, clearing fresh liquidations down to the 67.4 thousand mark. As the weekly open approached, they drove it higher to do a round trip to 69.5 thousand, just shy of the Friday CME futures close of 69.7 thousand. Seasoned stops have now been sanitized over the prior week between 70 and 74,000, clearing the path for price discovery to the upside. To the downside, concentrated liquidity depots reside between 61.5 and 64,000. In terms of market structure and confluence zone points of interest, 67.5 thousand is a key level. As long as this level holds, we expect near-term continuation to the upside. A breakdown in price action below 66.5 thousand increased the probability of a higher velocity move to the next projected reaction zones at 63 and 61.5 thousand. The market backdrop remains constructive, yet tentative. Sentiment remains bullish, as indicated by the Crypto Greed and Fear Index INGREED. Record highs in futures open interest and volatility markets call put skew positive in all expiries longer than 1 week. The FOMC meeting is also scheduled Thursday, but is less likely to provide a significant catalyst to markets, given near certainty of a 25 basis point cut. The results of the Tuesday US presidential vote will be in focus, as results get tallied in the following days, and potentially even into the following week. The Trump trade is based on perceived favorable investment implications for markets due to looser SEC oversight, bank regulation, and taxation. For crypto and Bitcoin specifically, there are additional implications relating to custody, even supply-demand, given Trump's explorative stance on holding Bitcoin as an asset or currency reserve on the US balance sheet. Volatility markets reflect the event risk, with the term structure of implied volatility inverting as the November 8th expiry approaches 90%, this versus 55% for expiries longer than March 2025. Participants in option markets short optionality or gamma also make for a potential squeeze in implied volatility as the week progresses, spilling over to longer expiries as participants roll their risk out of shorter higher gamma positions. This volatility could spill over to Bitcoin futures and spot markets as these participants choose rather to gamma hedge, exacerbating price action. In terms of strategy, we view risk-reward on speculative longs or shorts uninspiring going into the election, and prefer to exercise patience and opportunistic stance on trade setups. We reiterate our long-term bias to higher prices, reflecting our base case scenario of a Trump victory and an ensuing rally into 2025, with upside target of at least 81.5 thousand by January month end. The trajectory of price will, however, not be linear, and adjustments to our long bias will be contingent upon our model's interpretation of time price volume metrics at the aforementioned points of interest and liquidity zones to the downside. In the coming week, we see the most compelling opportunities to be in harvesting volatility premia, as the implied volatility term structure is likely to normalize, as shorter expiries mean revert to realized volatility following the election. We also acknowledge both right and left tail risks, with a positive catalyst leading to price discovery to the upside in a parabolic ascent, while a negative catalyst can initiate a descent to the range low of 52,000. This being said, we have implemented option structures that hedge tail risks. As always, do your own research and analysis. Be safe, and good luck in trading.